Hey, this is Tommy Johnson from the Portland Regional Chamber of Commerce. Thanks for joining us today for an excellent webinar that we're looking very forward to. Before I get into some of the introductions, I just want to go through a little bit of housekeeping. If you're with us now, you're here for the JPMorgan Chase & Company Global and U.S. Economic Update, Recovery After COVID-19. Sorry about that, a little technical difficulty. I want to take the time right now to set up a couple of housekeeping rules. Those of you that are joining us, you're on the YouTube channel. Over on the right-hand side, you can enter any of the questions you might have during the presentation in the chat box, and we will have folks that'll be feeding these questions to our presenter, Jim, at the end of the presentation. But without further ado, I'd like to introduce the folks who are joining us today from JPMorgan Chase. We've got Phil Puccia, who's the industry executive for higher education and healthcare in New England, as well as Mike Griffin, middle market banker in Maine. But let me introduce our keynote speaker today. Jim Glassman is the managing director and head economist of commercial banking. As a managing director and head economist for commercial banking, Jim provides market insights to help clients better understand the changing economy and its impact on their business. Mr. Glassman also works closely with the firm's corporate sector, including the chief investment officer and investor relations, as well as the investment bank and government relations groups, providing financial analysis and research. Mr. Glassman is regularly cited in the financial media, both broadcast and print, where he is also a frequent commenter on economic policy issues. Jim also has a weekly podcast called The Economic Take, which you'll be provided a link to that once the materials for the event are sent out. But without any further ado, please let me introduce Jim Glassman.
Thank you. Good morning, guys. There is no template for what we're dealing with right now. And long story short, I tend to think the way you're supposed to think about what we're living with here and what's going to happen on the other side is going to look or feel more like a natural disaster than a business cycle. To me, this is not a business cycle. This is we imposed this, and it's creating a lot of havoc. And I think when you think about what's ahead and how should we, what's the uncertainty that we're dealing with, I think there's three things to think about. The current situation and the way we're responding to it. I find I'm not really troubled by, I find that the policy response out of Washington has gone a long way to addressing the economic upheaval right now. If you look further out, once we get a vaccine, I think life goes back to the way it was. There will be some changes here and there. I think the horizon of uncertainty is really as we begin to open up states, but we insist on social distancing. It doesn't really work for restaurants, bars, fitness centers, airplanes. I think that's the most difficult thing to figure out. So that's why I kind of hope, we think there's going to be there's an awful lot going on the vaccination front. People are thinking that if the human trials this summer work out, we may actually have a vaccine by fall. But that means that there's a lot of uncertainty between now and when that happens. So let me first talk about right now what's going on. I think if you can get your hands around the nature of the disruption and the way we're responding to it, it gives you a better way to think about what comes on the other side. And what I mean by that, if you think about what is the extent of the damage that was being done by shutting businesses, we economists think that national output has dropped about 10% from the, say, February level. So that's going to show up when you get the GDP numbers for the second quarter. That 10%, the way it gets reported, it'll be annualized. And so what you'll hear is GDP down 40% at an annual rate. Now, what does that mean? If you divide GDP by 365 days in the year, what it means is that the folks who don't have a job to go to and they had to go to unemployment insurance, all the income that's lost by having the economy running at 90% of its normal level means that we're losing about $6 billion per day of lost income. And keep that in mind when you're trying to weigh what we're doing on the fiscal side to respond to that. $6 billion a day translates into about $500 billion lost income over the course of the quarter, 3-month span. Now, if you think about what we're doing about it, first of all those folks, there are about 60 million people who work for small businesses. We think about half of them had no jobs to go to. So they all rushed to unemployment insurance before they even knew what we were going to do about it. And that's why when you look at the number of people filing for unemployment benefits, the number of people actually getting unemployment benefits, it's up about 30 to 40 million cumulatively over the last, really since early March. And, but so keep that in mind, 6 billion a day we're losing. Now, what did we do about it? The policy response was really quite extraordinary. The government sent out checks. They're sending money into the healthcare for the healthcare providers, the healthcare system. We have economic impact checks that were mailed sent in the mail or electronically deposited. We buffed up the unemployment insurance system. And the most interesting thing is we created this program offered through the Small Business Administration that basically gives companies 2 months of free money if you use the money to pay your workers. We'll also pay your rent and utilities and mortgage payment with that. That's called the PPP program. The PPP program provides about $659 billion of support for the small businesses. We figure that if all that money gets in the hands of businesses and they take advantage of the 2 months of forgiven loans, that should be enough to cover roughly 57 million workers. Put 57 million workers back on the payroll of companies, at least for 2 months. So here's the thing. There's an agency called the Center for a Responsible Federal Budget that tallies up all the things that we're doing, the 4 initiatives, the executive actions from the White House. They claim that as a result of all these actions, we've authorized $4 trillion of money to be spent to help people. They're not earning their income from their jobs. So this is all money that's being used to support the healthcare system and provide income for people. Now, the interesting thing, we probably have distributed about half of that, $2 trillion. Now, here's the thing. People here, we've created this great program to incentivize businesses to keep people on their books, and we're spending gobs of money to replace the income that people aren't earning. And by the way, fortunately, we opened up the unemployment insurance system to people who are self-employed, the special program that was added there, because self-employed people, independent contractors are not really covered by the unemployment insurance system. So basically, we've got programs here that have covered at least 70 million people. Now, you could look at all this and say, well, what's the evidence that this is doing any good? Because we look at, there's still people filing for unemployment benefits. The number of people who are actually drawing unemployment benefits went up a lot, 20 million. For the first time in a long time now, it actually dropped this couple weeks ago. And you could say, well, what's the evidence? And this PPP program is, in my mind, lost in the conversation of what's going on. Everybody is very focused on unemployment and what's going on here. And they're forgetting that the whole purpose of this PPP program was to keep people attached to their jobs if you work for a small business, 500 or fewer people. And what that means is when the money gets out there and businesses take advantage of it, we should find nobody who works for a small business unemployed. They should be on the books of their companies. Well, why are we seeing all this unemployment? And if you look at the unemployment back in April, the telltale signs all tell you that most of the unemployment that you saw in April is people who worked at the restaurants, the fitness centers, the bars, all the folks who worked in small businesses. So you might conclude, well, this PPP program is doing nothing. But the thing to remember is it's a complicated thing. It took a lot of work to get it going. It's taking time to get the money in the hands of businesses. by 13th of May, we still only had, if you look at C&I loans at banks, commercial and industrial loans, where the PPP loans would show up, only 230 billion of the 659 billion program had actually shown up as loans booked at banks. So what it tells you is it just takes time to get that program in place. And I think over the next several weeks into June, what you're going to find is more news like what we saw this morning. People still filing for unemployment benefits, but the number of people who are actually drawing unemployment benefits went down very substantially in the numbers that we saw this morning. To me, that's the beginning of the PPP program actually getting traction, because a business can't bring their people back to their payroll until they get the money. And this is sort of the first time we're beginning to see that process. Now, the other thing to be aware of, and the reason I say I think we've got our hands around the extent of the problem right now through the policy process. Tomorrow, you're going to see a report called Personal Income. And what you should see, what we know as economists is when the government transfers income from the government to households, when they send me checks in the mail, when they supplement the unemployment insurance system, when they create programs to open up eligibility for people who didn't normally have it, the self-employed, the Uber drivers, what you're going to see is giving me income doesn't do anything to prevent GDP from going down, particularly if you can give me the income, but if I can't go to the bar or the fitness center, I can't fly an airplane, there's fewer options for spending the money. And what you're going to see, and this will guide your thinking about what you think is on the other side. What you're going to see tomorrow is the wage and salary income is going to be down a fair amount. Consumption will be down. We know that from the numbers, but you're going to see this massive transfer of income going on in the form of unemployment insurance, economic impact checks. The PPP money probably won't show up that much yet, but all this money we're spending, the $4 trillion that we've authorized to be spent, is showing up as income transfers. We learn in the first class of economics, when you transfer income from the public sector to the household sector, it doesn't necessarily do anything for GDP. It's got to show up in spending for that to happen, but it buffs up my income. And you know why I know this is happening, because you could ask yourself, well, where is the money? If we're sending checks to people and we're transferring income to the household sector, where would we see it? The first place I would look is the bank deposits that we all have. And if you look at retail deposits at banks from the end of February to the end of April, when all these programs began to get put in place, retail deposits are up about a little more than $2 trillion. So what that's telling you is this is not some abstract thing that's going on. This is where the proof of the pudding is in what's going on in all of our balances. And I think another way to think about what we're doing here on the policy side, I listen to the debate going on, and everybody is very distracted, confused, obsessed with the unemployment numbers. And we haven't seen numbers like this since the Great Depression. You get unemployment up in the 20% level. People are thinking you're supposed to talk about this the way a normal business cycle works. The way I think about it is all this money that we're spending to pump up, we've doubled the benefits that people get from unemployment insurance by adding $600 to the regular state benefits. The special program we created, the Pandemic Unemployment Assistance Program for self-employed people, the money we're going to spend on PPP, whether you are getting unemployment benefits from the unemployment insurance system, which are much more generous than they usually ever are, or whether your employer brings you back on the books and uses PPP money, effectively, the way to think about this effectively is we are giving anybody, most of these people who work for small businesses, it's paid leave, actually, paid leave. And if you're skeptical, what you should do, if you know somebody or talk to anybody who is on unemployment, ask them what they're getting. And what you'll learn for many people, what you'll learn is that the support people are getting from the unemployment insurance system, or if they're brought back to the books of their companies and getting paid what they were getting paid before, they're pretty much earning what they were earning when they were working. And that's why I say the policy response, the fiscal response, is basically replace the income that we're not losing. We're not seeing it in GDP, but you're going to see it when we let people go back to work and we open up the economy. What it tells you is there's a lot of cushion there. The income that we've been able to give people that they're not getting when they were working is going to be available for them to get started up again. And that was the whole idea of all of this. If you remember, when Senator Rubio and Senator Schumer articulated what they were trying to do, it was the right concept. What they were trying to do is try to keep people attached to their job so that when we get started again, it'll happen more quickly. And this is why I say when we get to the other side, I think this is not your father's recession. It was an accident that happened because this is the only way we knew how to manage the burden on hospitals. And the recovery on the other side is not going to be your father's recovery either. So another way to put this is forgetting about the uncertainty of how quickly can we get back when we've got to follow social distancing guidelines. If you had asked me in the last recession, 2008 or 9, how long, based on what we know about economic cycles, how long will it take for the economy to get back on its feet? I would have told you, and I did back in 2009, that a thing like this takes about 10 years to get back on our feet. A normal business cycle. Bad recessions take longer, shallow recessions take less time. But this is not your normal business cycle. This was a deliberate response to manage our healthcare crisis. And in my mind, the way I think about this now, I think it's not unreasonable to assume that within a couple years, we'll be back on our feet, back where we started back in February. And it's going to take, you may be skeptical for the next 6 months or so until we get some kind of vaccine, because it's kind of hard to figure out how a restaurant runs a business profitably by keeping people spread out. It's kind of hard to see how the schools are all talking about opening up, but they're trying to figure out how to get kids in living spaces where they're more spread out. I don't know how that's going to help, because I might be more spread out. I might find an apartment that I don't have to live as closely with everybody. But then when I go to class, or when I go to the bar, or when I go to the games, I'm back in again. So I think if you think out, we're all asking ourselves, how is life going to change as a result of this crisis? And there's a lot of interesting things you could think about. Personally, I think the main thing that we're going to find is that this crisis is just going to accelerate some of the things that were going on already. A lot of the innovation that was going on, many of us are figuring out how to do more shopping online, virtual communication, all the technology that is opening up. Not everybody uses this. In fact, only 15% of retail sales is online sales. So that tells you, I think what's happening is a lot of people are realizing or figuring it out as a result of this crisis. So I suspect that this crisis is going to just move things faster in that direction. But I think the area that's probably going to see the greatest change is the area that has seen the least amount of innovation, and that's the healthcare sector. I think what the crisis is doing is exposing a lot of challenges we had in healthcare. When you have a private healthcare system, it's not, you can't expect a private healthcare system to be able to build the capacity to handle pandemics, which happen randomly and are expensive to do. And I think what we're going to learn is the federal sector is going to have to be more of a partner here. But also, when I listen to equity analysts, I often hear it said that healthcare seems to be the one area where innovation has made the least inroads. I think this is going to change, and I think the crisis is making us focus more on our healthcare system, because we just cannot afford to we can't afford to shut the economy down to manage the burden on the healthcare system. And that was the reason we went down this path. And so I'm hopeful you'll see some big changes there. But I think once you get a vaccination, for all the folks who are asking themselves, are we going to have to rethink office space? Are we going to have more people working from home, and we're going to have to rotate working schedules? I think if you assume we're going to have a vaccination, and honestly, I wouldn't. There's a lot going on, and there's a lot of competition going on, whether it's the Chinese side or the U.S. and the Brits. Everybody in the world is focusing on trying to get something moving, and there are a lot of things we can do to make it happen faster than what the consensus view before we came into this is. Well, it sometimes takes a year or two. I don't think so. And everything that we see going on the antiviral front or the vaccination front seems like it's moving faster than I might have guessed early in the year. So I think when you're trying to figure out what's life going to look like on the other side, well, if I have a vaccination that makes me no longer afraid of getting this thing, I'm going to be very quick to get back on an airplane, to go to Disney World, to go to the bar, to get to my gym. And all the more so the younger I am, because I think a lot of young folks, they have better immune systems. They're not as vulnerable. And I think for all of us who are older, might be more vulnerable, we're going to have to be more careful until we feel comfortable with the biotech solution. But I think, so what this tells me is, I think we've got our hands around the near-term problem. I wouldn't stress out too much about the unemployment numbers we're seeing, because I think we've done a lot to replace the income that those people were earning, and it's going to help them when we get back to work. A lot of purchases were postponed, car sales were, a lot of transactions were postponed. Those can easily be made up. Service consumption is not an easy thing to make up. If I skip a haircut, I'm not going to get 2 haircuts when the barber comes back. So there are things that are going on that are lost forever. But I think when you're spending the kind of money we are to replace the income that was lost, we've done a lot here, and you got to give Washington credit to do this kind of thing. If you had asked me back in January, given how polarized the country is, what are the odds that Washington's going to be able to come up with the right kind of initiatives to address the areas of our economy that are most vulnerable? That is, the folks who work in the industries that we shuttered: restaurants, bars, fitness centers, sports venues, amusement parks, all those guys. If you had asked me, what are the odds that the Congress can come together and come up with programs that can help the very people who are most vulnerable, I would have said it doesn't seem very likely. And I think that's exactly what we've gotten. Nothing's perfect, but I think what we're seeing coming out of Washington has been pretty unprecedented and gone a long way to repairing the damage that you see in the unemployment numbers. So when you see and hear discussions about unemployment, just keep in mind there's another side to that story, and that is they may be unemployed, whether they're on the unemployment insurance count or whether they're being helped by the PPP program. They're still getting money that's pretty much offsetting a lot of what they were earning before. So we got a lot of challenges ahead. There's going to be a lot of unknowns. I think the biggest unknowns, frankly, are just how are we going to get back to work, back to life, while still following guidelines of social distancing. You can't make money running a restaurant with half the customers that you normally have. The margins are really thin. So how that's going to work is really the most difficult. But I think we're only going to have to live with that for several months, and then every day that passes, you're getting closer to some kind of medical solution. And honestly, if you're skeptical, I think you have to ask, what could be going on in the equity market? Because the equity market is not behaving like we're in a once-in-a-century event. The equity market seems to be behaving that, okay, this is bad news, but we're going to get over it. And it won't be that far down the road that we're back. Otherwise, I think it's very difficult to figure out how you justify what the market's done, what the valuation of the market has done. The market, anybody who went to sleep 10 years ago and they woke up today and they looked at the equity market, knowing where earnings are, they would pretty much characterize the stock market as generously priced. And that's relative to earnings that are historically high, 50% above the historical average. So that's all happening because there are some pretty interesting things going on in the US economy. We learned as of February that we're able to get unemployment levels really low without having inflation. We learned that there's a lot of innovation going on. That is at the heart of what's driving earnings, because it's all about the Amazons and the Googles and the high-tech companies. And we also know that the globalization that's been going on is opening up new market opportunities all around the world where people have been very impoverished and they want to be where we are. And that's opening up opportunities for all of us. So I don't think this crisis changes that story. And that must be why the equity market is doing where it is. So I'll leave it at that and open up for some questions. I think recognizing that it's going to be challenging for the summer months, it's going to be challenging. But I think there's reason to be hopeful and there's reason to be optimistic that this is going to play out quite differently than a normal business cycle does. And I think we'll get back on our feet more quickly than you might expect, given all this disruption and the upheaval that you see in the US economy. Why don't we open up for questions if we can, Tommy?
Yeah, thanks, Jim. Thank you so much. And I know we've got a couple of questions. I think Phil and Mike, we're going to tee those up. I'll let Phil go right ahead.
Hey, Jim, thank you. I was wondering if you might comment in a little more detail about the huge growth in deposits and how that might impact what the shape of the comeback, and what industries might benefit the most and what might be slower on the uptake.
The buildup in retail deposits, by the way, it's not because people are panicking, stuffing money under the mattress, selling their equities, right, and dumping it into the banks. Because when you look at the flows in mutual funds, they're actually up. The net flows out of equity mutual funds is basically nil. This is a story about federal money that's being sent to people. So it's unemployment insurance benefits, it's the economic impact checks. So I think the way to think about it is this is providing the ammunition that will support pent-up demand, pent-up spending. And when we get to the other side, I mean, you can send me a check, but if I can't go to my gym, which I can't, if I can't fly, if I can't go to the ball game, there are just fewer options for spending the money, and I don't have to get a haircut. So I saved one round of haircuts, by the way. So I think the way to think about this is, if it weren't for the fact that we're going to insist on social distancing, and we may find better ways of doing this, actually. We might find, rather than keeping everybody distant, taking their temperatures, monitoring them, giving them more ways to keep clean, good hygiene, we might find that that's the way we get around this. But ordinarily, I would tell you, the sectors that should come back the fastest would be the ones that have been the ones that we shut down. The restaurants, the gyms, the airplanes, the hospitality industry that is supported by that. And honestly, I think for restaurants and bars, it's harder to figure out how they're going to come back that quickly if we're going to insist on social distancing. But I'll bet you there's just a load of people who are anxious to get back, to go visit family, to go to Disney World, to get back on an airplane. If I don't have to worry about the virus, then I think a lot of that's going to come back very quickly. So I think we're all, we all have to eat. So whether you're buying stuff from the grocery store or taking out from your restaurant, that's not going to recover. That's already doing pretty well. The shopping online, it's doing pretty well. My guess is when you open the stores, people are going to be in a rush to feel normal, to get back to normal. So I really think, although it's hard to figure out how some of these businesses can get back quickly, I really think it's the ones that have been starved that are the ones that are going to come back the quickest.
Okay, thanks. Here's a question from someone in the audience. I'd like to get your take on, the outlook for housing for the balance of 2020. Is it typically a lagging indicator? And, how will the current unemployment rate impact, houses being built and bought and sold?
See, I don't think the unemployment rate is a factor in this myself, because the unemployment is largely be driven by the folks who work in the restaurants, the waiters, lower wage guys, the lower paying jobs. But the other thing, the other reason I don't think it's much of a factor is because I may be unemployed as a waiter, but I'm getting income that I was not by not being at my job. And there's an interesting anecdote. Everybody is worried. How are we going to get these people back from unemployment insurance? How are we going to get them back to the job? Because they're all realizing that they're earning more money on unemployment insurance than they were on their job. That's just another reminder that the income support from all these federal programs is actually working. And I thought it was really, really interesting that Senator Rob Portman, he's got a proposal. I'm not sure how many people support it. He's got a proposal to replace the $600 federal supplement to unemployment insurance with a bonus payment if you'll go back to your job when the PPP money gets spent. So I think for housing, housing was, when we came into the crisis, housing was one of the areas that was actually looking quite strong. And through the winter months, it was doing really well. And I assumed that was because low interest rates were helping. Well, that's going to be a plus for a while. I think the interesting story that remains to be told about housing is more subtle. And we already knew from before this crisis, if you look around the world, around the country, urban markets that were getting very expensive, it seemed to be pushing people inward. And it seemed like you were starting to see an organic rebalancing going on. It was getting very expensive to live in the big urban areas, San Francisco, LA, Seattle, New York. And when you look at trends that were going on, it seemed like the population was kind of slowly migrating to more affordable areas. Businesses were maybe doing that also. So that's how you explain the strength that you were seeing in Denver and Nashville and Greenville and Chattanooga and other areas. And I think so that was already going on. And if you look at the price of housing, the cost of living around the country, these urban areas have gotten very expensive relative to other areas. I think this crisis is another add-on that's helping housing, and it may be very subtle. You may not see it right away, but I think there's a lot of rethinking going on about the advantage of living in an urban area. And my real estate agents, for example, I live down in the middle of New Jersey outside of Princeton. Real estate agents are telling people, don't be in a rush to sell because there's a lot of rethinking going on for folks in Manhattan, and thinking maybe it wouldn't be so bad to move further out. And maybe if we all learn to work a little more remotely, maybe that's helping. So honestly, I think in my mind, the outlook was already quite good for housing. I was thinking 1.5 to 1.6 million houses a year was a reasonable starting point. This may add to that because I think we're going to see the country kind of rebalancing a little bit. And when people move from one area to the other, you can't move the houses. So you need the houses where people are going. And I think the other thing that's helping is we had a population, our young adults, the folks who are now in their 30s, when we went through that last recession, there's a whole population of people. I sort of think of them as the 3 to 5 million people who came out of school, couldn't find a job in 2009, 10. Many of them just went back to school. They postponed life decisions. People get married later today. They start families later. And that had a real big impact on housing. Household formation was very slow for much of the last decade. Well, as those folks are now, more planted and they're starting families, you're starting to see all that pent up need unlocking, and people don't want to live with their family anymore. They're finished up with school. So to me, the demographic, the thing that was caused by that last recession is just kind of postponed a lot of normal purchases, and housing is really one of the biggies. So I think that's why when you looked at what was going on with housing, it was hard to tell how much of this is the benefit of low interest rates and how much of it is just that people are now finally getting to start life 10 years later. And that was consistent with what you were seeing when you looked at household formation. So I personally think the outlook for housing is decent, and there's nothing that I've seen that makes me think all that we're watching should be a negative for housing.
Hey, Jim, it's Mike Griffin. I've got a question from Nate Moody of LaBelle and Harriman. And I'd start with it. It's of a concern about labor shortages. In Maine is certainly not immune to that challenge. So specifically, he just really wants to know, are you concerned that with every recession, we see a large cohort of unemployed workers that don't re-enter the labor market, and some may never, and just really wanted to understand what your thoughts are on this topic.
Yeah, that this has been the big story we've all been focused on, because you think about it, when we went into the last recession, it was very bad. And over the course of the last decade, our economy got back on our feet and we got unemployment down to 3.5%, the lowest we've been in 50 years. And you might ask yourself, well, how did that happen? How did we get unemployment so low when we had a kind of a mediocre performance in the economy in terms of growth? Well, the reason, and it gets to what you're getting at, the real driver, the real thing that's going on here is not recessions. It's not that recessions just people give up and they go away because they get tired of it. What's going on is the demographics is changing very dramatically. It's the aging of the population, the baby boom phenomenon, and the growth of the working population has slowed down really dramatically over the last 10, 15 years, which is why we got the economy back to a low level of unemployment, and we can't find anybody. Before we went into this recession, there were like 7 million unfilled job postings. Shocking, because if you could fill those jobs, we could grow a lot faster. And even now, after the crisis, I think as of March, we still have something like 4 to 5 million jobs we can't find people for. And to me, this is largely not about the damage done from a recession that just threw people off. It's because you've got more and more people aging. For example, give you a number. A decade ago, the number of people who were working age, 16 years of age, call it 70, it was growing about 200,000 a month, which is why we all thought you had to have employment growing about 200,000 a month in order to keep unemployment steady. Well, in the last decade, the number of people who are working age has steadily declined, and it's now growing about 50,000 a month. That's because you got people, as they get closer to 55 and older, they start dropping out. So to me, it might look like what's happening, because we get these recessions periodically. So it might look like recessions are just, we're just losing people because of the recessions. It's really about demographics, which tells you the way to answer this challenge is to reform immigration. Because if there are jobs here, there are plenty of people somewhere that are happy to take them. And I really think this is one of the easiest ways to get more energy in the U.S. economy. And it's a demographic reality that guys in Japan know about this. This has been going on for a long time. In Europe, they know about it. In America, we never really had to think much about this, because whenever our economy did better and we had jobs, you tend to find people would come here. But I think that hasn't been happening over the last decade. And it might be because people were hearing about all this slow growth in the US. There's nothing going on. And I think what's important, though, is everywhere you go, people are hearing this crisis has thrown us off a little bit, but everywhere you go, you're hearing people say, we just can't find, we have all these jobs, we can't fill them. So I think, for local communities, the smart thing to do is to try to figure out how to advertise opportunities in your community, because you look around the country, we've got little towns, you wonder, where did they come from? Well, the same phenomenon happened. Somebody figured out there was a job there was a cousin there. And I think the way to deal with this is to try to figure out how to make it apparent to people, advertising where the job opportunities are. And so I think it's the demographics that's really the bigger issue than the damage from recessions. Because when you look at people who are older, this is the typical experience you see. When we get out of school, turn 20 to 22, about 80% of us go work. It stays that way till about 50 to 55. And then once we turn 55, for some reason, people start leaving. And it drops really dramatically. And it's always been that way. You take a snapshot of the labor market 50 years ago or now, it looks the same. This is just what happens. So it's a reminder. I mean, you might be able to keep people on the job longer if they're older, but honestly, there's a limit to that. And people, when they get in their 50s and 60s, they want to move on into other things. So it's a real big, to me, this has been one of the biggest challenges, the most surprising challenge. And the fact that we have unemployment at very low levels, even though our labor force has been slowing down, it's really because we as a country are aging. Like in Japan, and like what's going to be going on in China, and Europe knows this story as well.
Thanks, Jim. It's Phil again. In this morning's Portland Herald newspaper, there was some reports on, the governor extending some of the closing periods for local restaurants. And I was just curious if you could comment on sort of consumer and business owner behavior as we see government, rules and regulations, and what will ultimately drive these openings. We saw all the pictures from the Ozarks last weekend, and in Texas, there's now an organized protest of 1,000 businesses opening against the governor's orders in New Jersey. What ultimately rules the day here as we move forward over the next several weeks and months?
Yeah, I think we do. We the humans who are getting tired of staying in our houses. And, it doesn't mean that there aren't dangers, but I think the problem is people are beginning to, I think we've lost connection with why we went this path from day one. If you remember back in February, when the health officials were talking about this, what they told us was our hospital system does not have the capacity to handle a pandemic on top of the normal flu season. And you had these projections from the University of Washington talking about we didn't have enough ventilators, we didn't have enough ICU beds. And so reasonably, we decided, our leaders decided, that the only way we could really, it didn't seem right that we should force doctors to have to make a decision who gets to live and who doesn't, that the system didn't have the capacity. And it's important to remember that logic, because now, what you notice now, and I think this is missing in the conversation we're having, which is why the public is growing restless about this. When you look at what's going on now, we've gotten a lot smarter about, we've got this voluntary system for redistributing ventilators, and suddenly we find that we've got more than we need. And the flu season is passing. And the number of people with COVID-19 infections is very slowly coming down. And I think what we are realizing is that we now have the capacity to handle this. We also don't talk about it much, but shutting the economy down has a major impact on health also. There's a lot of consequences of this. So I really think that what's happening is the governors, I can understand what they're doing. I mean, you don't want to be accused of moving too quickly, because people are going to get this infection, and then there's going to be casualties, and you don't want to be, you don't want to be in the center of that. So I think at the end of the day, though, it's the public that's going to drive this, and we're just going to have to get smarter about the social distancing. There are probably many ways we can figure out how to manage the spread of the virus, better testing, better hygiene. I don't know that we need, I don't know that we need to go to these extremes of keeping people 6 feet apart, but they're probably, and I think the public is getting restless about this because they're realizing that there's everything in life, it is a matter of trade-offs. And I really think this is a little extreme what you're seeing when people go crazy and they're all on top of each other, like the Ozarks or the beach. But if you're, honestly, if I were 22 years of age, I probably would be in the same boat. I wouldn't feel vulnerable if I'm healthy and I'm young. I think it's that population that feels like it's time to get back to work, and let's try to be smart about how we do it, but let's not be crazy. So I think, the governors, the regulators, the health officials do have some leverage over restaurants, because if you can label a restaurant as not healthy, no one wants to go through that. But I think the guidelines coming from the governors are really more, let's be smart, let's be responsible. And I think the public is going to probably drive this, because I'm noticing where I am, even we're a bit germophobic in this area, and the governor's been really very restricted. He's having to loosen up quicker than he might have wanted to, and I think it's because the public is insisting on it. And I think the thing that the health officials are worried about is, well, what if we get back to work so quickly and you end up with a flare-up, a new round of infections? Well, that's why I think the thing to do is to keep an eye on the possibility of a flare-up in the COVID-19 infections. And the thing that I'm watching that I think is really fascinating, there's a company called Kinza Health. They have a population of 1 million people. It's supposedly statistically representative of the country, and they give them digital thermometers, and it feeds real-time information to the company through their iPhones and their iPads. And they're able to track the population that has fevers county by county. You can look at this. Go to healthweather.us. You can pick your county, and they'll show you what's the normal pattern, what's the expected, and what's going on. And when I look around the country, every single county, Georgia kind of was the first to open up more quickly. Then you got Arkansas, you got New Jersey Shore. When I look, it's a little early still, because sometimes it takes several weeks before you would see some impact here. But I'm watching this information because so far, you're not seeing much evidence that there's a flare-up in new COVID cases as we open up and get the economy back. So I think between the public being restless to wanting to get back to something more normal, and the health evidence, if you can just find a way of tracking the population that might be ill, plus the fact that our hospital system is better able now to handle people who are ill, that so ill they got to go to the hospital. I think all of that kind of plays into this calculation of are the governors going to gradually be more relaxed? I would expect the governors would be the slowest to want to get back to normal, because they're so nervous about the chance of a new flare-up if we have this. But honestly, if we're lucky and we get a vaccination by fall or before the next flu season, then I don't worry so much about the risk that getting people back to work is going to cause a whole new wave of epidemic.
Thanks, Jim. It's Mike again. Jim, a lot of Maine businesses and families are hurting. That's obviously no surprise. We're grappling with this health crisis. To your point, the government stepped up in a major, even unprecedented way. You think of PPP, Main Street lending, a whole host of other supports. What if the crisis persists and we have a second wave in the fall, or to Phil's point, restaurants reopen more gradually? what are you looking for from the government? Are there KPIs? Just how do you think about for Maine specifically, but how do you think about the policy response, the Fed, local governments, et cetera?
I think we learned that because we as a country chose to shutter a lot of businesses. So this is not an accident. We imposed this. So it's only right that we should then want to make people whole or buy time. And I really think, I hope we don't have to, if we have to extend the shutdowns, I hope it's more limited. But I think we're going to find out if we have to do that, we're going to find out that Washington is prepared to do more. I think they are quite committed to what they did. And I think they realize it's doing what they hoped it would do. I think it'll be more visible in the month ahead, next month or two. The benefit of the PPP program, I think, will become much more visible. You'll see more reports like what you saw this morning, the number of people who are actually on unemployment dropping. It's dropping only because businesses are bringing them back to their books. So I'm pretty sure we'll see more action if we need it. And actually, both sides, McConnell and the Democrats are talking about a fifth initiative, a fifth coronavirus initiative. There's a lot of pieces of the economy that we missed, maybe the municipalities. There's a lot of municipalities that depend on tourism. That's not happening. So there is still work to do. But I think I wouldn't, if it turns out that we see flare up of this again, and we decide we need to extend the shutdowns, if we do that, I think you'll see a repeat of what we've been doing. And I think, periodically, the way to understand, even though the health officials are saying, you got to be careful here because we're going to get another flare up if we have people going back so too quickly. But you're hearing the administration say, I don't think we'll repeat the shutdown. And I think the reason is because we're realizing it is very damaging. It's very expensive to keep the economy in a flight holding pattern. And second of all, our medical system is better able right now to deal with an epidemic than it was 3 months ago. So I don't think I wouldn't worry too much about us not having the stomach for more. It's pretty amazing. For all the complaining about budget deficits, we were pretty quick to spend money, Republican and Democrat. We're pretty quick to spend money. And it was the right thing to do because if we didn't do it, it would have caused a lot more problems and it would have cost more money, I'm pretty sure. So I think in our gut, whatever our politics is, we know, we've learned over the course of centuries that when we get into trouble, the smartest thing to do is to try to figure out how to get us back, because there's a lot of lost opportunity that happens when you have people out of work and an economy that's on its back. So I think that theme is what's going to guide any future policy response. And here we are, we're already talking about opening up the economy, and yet from Washington, they're already talking about a fifth initiative, which is pretty telling.
Well, Jim, thanks so much. This is Tommy again from the Chamber. A lot of great questions, a lot of great content. So we can't thank you enough. For those of you that are listening still, please know that an email will come out with a recap of this. There will be some slides covering some of the content that Jim covered that we'll include as well. There'll be a link to Jim's podcast, Economic Take. I do encourage you to check that out. It's pretty valuable, and that comes out pretty frequently. And I think a lot of people get a lot out of that. But again, I can't thank Jim enough, and to the team at JPMorgan Chase. Those of you who attended, thank you very much and have a great day.
Stay well.